Recently, I've been paying very close attention to insurance companies, and there is good reason for that. If you think about insurance as a business, people are paying basically a monthly subscription fee to keep their insurance, whether it's on their vehicles, homes, pets, whatever it may be. So, this creates very consistent, very predictable revenue. And if a company is able to grow their user base, they are going to see their premiums increase in a massive way and ultimately be able to hit profitability. And the other side of all of this is once a person establishes themselves with an insurance company, they are very unlikely to switch. So, what we are going to do today is we are going to dive into two small cap insurance companies and we are going to look over their business model, the numbers behind the business, as well as I'm going to give my opinions on where these stocks will be trading over the next couple of years. And let's start off with a very popular one, which is Lemonade. Lemonade year to date is up 44%. However, back in April, the stock fell to around $25 per share. And from that period till now, we have seen an increase of over 100%. However, over the course of the last 5 years, this stock is down since its IPO back in 2020. It did hit a peak of around $160 per share in 2021 when we were seeing a lot of speculation in the stock market. And in terms of Lemonade's business model, they are obviously an insurance company that focuses on using AI and different algorithms to try and optimize for better prices for their customers. They offer insurance across a number of different platforms, whether it's renters insurance, homeowners, car, pets, or even term life insurance. Overall, looking at Lemonade's numbers, they are clearly still in their growth stage. Right now, analysts are projecting that top line revenue for 2025 will grow by almost 36% to around $715 million. And oftentimes, when companies focus on top line growth, the bottom line tends to struggle. For 2025, analysts are projecting that EPS will come in at negative $2.70. That is a little bit of an improvement from 2024 when they put up negative $2.85. However, there is a big jump expected in 2026. Right now, analysts are expecting EPS to come in a dollar better with a loss of negative $1.69. And the great thing for shareholders is Lemonade is clearly showing that they have a focus to get to long-term profitability over the next few years. One of the key metrics for them achieving this is their gross loss ratio. Gross loss ratio is basically a ratio of how much premiums they take in versus how much are they having to pay out in insurance claims. And what we can see is back in Q2 of 2023, they had a gross loss ratio of 91%. So they were paying out 91% of their premiums in insurance claims. However, in Q2 of 2025, they have been able to drop that ratio all the way down to 70%. And the way that Lemonade is doing that is by leveraging AI. Personally, I hate when companies just use AI as a buzzword to really get more views and excite investors. But what Lemonade is essentially doing is they're using AI to collect data across all of their different customers and then looking at those customers and optimizing premiums that they are charging them based off a number of different risk factors. And what that ultimately has led to is massive increases in the amounts of premiums that they're bringing in, while their expenses have stayed basically level over the last few years. A very straightforward example of this is they have been able to grow their customer account by 800,000 over the last 2 years, but their headcount has actually declined by 4%. So there's a clear path to profitability for Lemonade. The way they do that is they continue bringing in new customers, and as long as they are able to not expand their expenses in a massive way, which they have already proven that they don't need to do, then they should see increases and positive movements on their gross loss ratio. If their gross loss ratio is able to get down even further to 65, maybe even 60%, they should see a massive increase in how profitable the business is. And right now, the company is projecting that they will hit net income profitability by the end of 2027. However, in my opinion, when I look at Lemonade stock, it is currently up around 250% over the last year. That means that a lot of this information is starting to get priced into the company. And if they miss these targets at all, if there's any sort of fault in their profitability or lowering of guidance, maybe they push out profitability till 2028 or 2029, then we could see a major drawdown in the stock price. And we've already seen these types of drawdowns with Lemonade. In November of 2024, the stock was trading for around $52 per share. However, by April, it had fallen by over 50% and was trading at a price of around $25 per share. So, in my opinion, over the next couple of years, there could be a couple of more buying opportunities for Lemonade. But at the current share price of $52, I think it's probably on the higher end of where you can get it over the next 3 years. But we have a little bit of a different story with the next company up here, which is Root. Root over the last 6 months is down by almost 23%. And from its highs in the last year, it is actually down by over 50%. So this is a stock that is clearly on a dip. However, unlike Lemonade, Root is purely a car insurance company. And also unlike Lemonade, Root is profitable. In 2025, they're expected to put up EPS of $2.11. That is up from $1.99 in 2024, and then it's expected to grow significantly in 2026 to $2.62 of EPS. Do keep in mind that there is only one analyst covering this stock on Yahoo Finance for 2025 and two for 2026. However, for revenue, there are 4 analysts covering this stock, and Root does have a little bit less growth than Lemonade. They are only expected to grow their top line by 24% to around $1.5 billion of revenue. Right now, analysts only expect Root to grow their revenue by around 8% in 2026. However, I think that that is a little bit low because Root overall, again, has a very similar business model as Lemonade. And as long as they keep delivering on that business model, they should be able to see large amounts of top line growth as well as expanding bottom line growth. Again, they are basically utilizing data, evaluating customers and the risks that come along with those customers, providing customers with better rates than conventional insurance companies, and then those rates are attracting more customers, helping to grow the business, and then they get more data from those customers, and this flywheel just keeps spinning around and around. So as they get more scale, we should see their bottom line and their top line expand. The reason Root is a profitable company is because they have taken a little bit stronger focus on their gross loss ratio. And they've been able to navigate this through a number of different difficult economic situations. Whether it's the pandemic or inflation going on, they have been focused on lowering their gross loss ratio. It is now sitting at a ratio of 59.6%. That means that they are only paying out less than 60% of their premiums and they are holding on to the other 40%. That is a huge thing for the profitability of these insurance companies. The reason that Root stock is down is because there's a lot of internal selling pressure that has investors concerned. One of those internal sellers is Malik Meyer. Malik Meyer is actually a venture capitalist who owned around 10% of the company, and he recently sold off around a third of his shares, selling off 225,000 shares, and he now only holds around 500,000 shares of the company. And this actually reminds me a lot of SoFi stock, because back in 2021, a lot of venture capitalists that got into the company when it was private ended up dumping out of their shares. And this resulted in these really weird spikes up and down in stock price for SoFi. So we could potentially see a big dip here with selling on root stock, and then potentially over time, especially if they are able to keep up on their top and bottom line numbers, we could see the stock take off in a major way. So for me personally, I will probably wait on Root for an investment into that company. However, what I think is very interesting is what you can learn from Root and their economics over time. If we look at their net income, they hit profitable net income around Q3 of 2024, and they hit adjusted EBITDA profitability around Q4, Q1 of 2024, kind of in that time frame. And what we can see is we can actually go back and look at the stock price around Q3 of 2024 and what was happening during that time frame. Here's what we can see by looking at Root's stock price over that time period. From July of 2024 through till October of 2024, the stock fell by almost 50%. However, when they came through and announced positive net income, the stock price ran up by almost 200%. In my opinion, looking at Root's chart over the last few years, it is very comparable to Lemonade. We've seen a massive move up in Lemonade's stock price. However, what we could see over the next year or so is a 50% drawdown on Lemonade's stock price. And heading into 2027, if they are able to achieve positive net income, we could see Lemonade's stock spike up by 100, 200, maybe even 300%. But obviously, that is just my opinion. Don't take that as financial advice. But I think this is a very interesting setup for Lemonade stock over the next couple of years. And if they're able to hit this profitability target by the end of 2027, we could see a massive move up in Lemonade stock price. So for now, this is just a watch position for me. It is going to sit on my watch list over the next couple of years. And if we see a big dip, then maybe it will be time to buy. But for now, I do not hold the stock in any of my portfolios. This is the YouTube portfolio, and right now it's sitting at a value of just over $72,000. And the positions that we do hold in this portfolio are Google, Supermicrocomputer, AMD, United Health Group, Microsoft, SoFi, Oscar Health, Adobe, Abercrombie and Fitch, PayPal, Alibaba, United States Lime and Mineral, Zeta, Estee Lauder, and Hawkins. But as always, let me know in the comments section your opinions on these two companies. Do you own Lemonade or Root stock? Which one are you more bullish on over the next few years? And where are your price targets by 2026 or 2027 for these two companies? Let me know down below, and while you're down there, drop a like on the video and subscribe for more videos like this one. And as always, have a wonderful rest of your day.